name is Warna Arid. I'm a real estate broker with Elite Residential Realty, and today I am talking to Jeff Baum. He's a loan officer for over 25 years now, and he's the president and the broker of CSMC Mortgages. So Jeff, hi. Thank
How are
you for being here today. I'm
You're
great,
welcome.
thank you.
Sure thing.
So let's dive right into mortgages,
Okay.
okay? The talk of the town.
Yes.
Yes. So what are you seeing happening in the mortgage industry?
Well, the mortgage, rates are a little higher than people want to see them right now. What's important is to get into a good property, and you can always take a mortgage now and then refinance later. The only issue is we have affordability problems. So we have tools to help out with the affordability problems, different loan types, down payment types, things like that. So that's what we're doing to help people qualify.
So
to
what do you
get into
mean
these
when you say
mortgages.
affordability? Explain
Well, you have typically, it's, people that pay, let's say they're paying $3,000 a month for rent, and then to buy the equal house with 10% down, maybe their payments are $5,000 or $6,000 a month, and that is a lot more than what they're paying for rent. So what happens is people see that number and go, oh my gosh, we can't afford that. So we have some tools and stuff to help ease that payment shock, if you want to call it that. So that would be on a case-by-case basis, but we do have tools to help with those things.
All right. Do you want to give a couple examples of what are those tools would be?
Well, in some cases, if you owe a bunch of money, so instead of, let's say you owe a bunch of money on credit cards or cars, instead of putting 20% down, let's say, maybe we only put 10% down. And then we take that other 10%, pay off those other debts. Because your mortgage debt is gonna be a lot less than the credit cards and the car payments.
I mean,
So
the
that's-
rate on your mortgage would be
Yeah, the
much
payment.
lower than
So
your,
for instance, we may be able to reduce $2,000 a month worth of credit card and car payments, and maybe only have a $500 more payment on the mortgage,
okay.
right? So that helps with affordability, so that number's not as scary.
Right, so actually, if they only put 10% down, now we're looking at a higher mortgage payment and a PMI, which is the mortgage
Correct.
insurance, so they kind of have to weigh
Yes,
which way it makes more sense.
yes, and we have to, every situation's gonna be different, so we have to balance it out and see what makes the most sense.
Just to make sure I understand, so if they pay off some of their debt, then their interest rate would be lower, right?
Yeah, because ultimately, hopefully, their credit scores would come up. Yeah, and that's a timing thing, and we have to kind of look at that too, to see if we can help. Once they pay down their credit cards or pay things off, then we may have to have them go to the credit companies and have that reported properly, so it brings up the credit scores.
Okay, let's talk a little bit about rates.
Rates. I don't think rates are that bad. I think that we go in ups and downs. Obviously, rates have been, 2, 3%, 4% for many years. I think that was an anomaly, to be honest with you. I think 6, 7% is kind of a normal rate. I mean, we've seen rates in my time, especially when I first started, rates were 12, 13%, right? So you have rates that move around, and my recommendation is, you marry the house and you date the rate, because when rates come down, in my opinion, I think there's going to be more offers on houses, on listings, and everybody's going to want to jump in the market. Right now is a perfect time to buy, because yes, you're going to pay a little bit higher rate for a while, but you could potentially get the lower price on that home, because if rates drop enough, you could get into multiple offer situations with these houses, and they could be driven up quite a bit.
Okay.
So there's a balance there.
Right. So just to put things in a bit of a perspective, interest rates in the 80s, in 1981, they were 13.9% on the average. The year actually closed with 14%. In 83, there were 11. I'm sure that was a great rate after paying
Oh, yeah.
14, right? In 86, it came down to 7.7 as an average, but the year actually opened with 9. And 1990 started with 7.9, and then the average that year was 8.6.
Yeah, I remember, because I started in the early 90s, and I remember the first time it went down to 6%, 6.25. That was like, wow,
Right,
right?
right.
I can't believe I got 6% or 6.25. So these are normal rates, and it's just a matter of trying to figure out how to make this work for you. And then when rates drop, we refinance you and
Yes.
get you into a better, more comfortable situation.
Yeah. Let's talk a little bit about first-time home buyers.
Yeah, so first-time home buyers, there are some programs depending on areas where you could get grant money. You could get
Areas, you mean geographical areas?
geographical areas, and in some cases, those have income limits. You have to kind of fit in the box. But there's those programs out there. It seems like we have a lot more flexibility if we kind of stick with the 3% down, Fannie Mae, Freddie Mac, or 3.5% down FHA, depending on, what we need to do and what the situation is at the time. Everybody has a unique situation, whether it be credit scores, income, debt, dynamics. So we evaluate all those things and put, and recommend programs that fit their needs. To me, loans are tools, right? I reach in my toolbox and I use loans to accomplish what my borrower wants to accomplish. That's been my goal for years.
Can you explain a little bit what actually determines someone interest rate? I think you kind of touched on it a little bit, but
Yeah.
maybe you could elaborate a little bit.
Credit scores, mainly credit scores. Income could have some issues if their income is low and their debt ratios are a little bit too high. That could impact the rate. Down payment could affect the rate. Whether it's a condo or a house, condominiums typically are a higher rate. There are quite a few factors, so that's why it's kind of hard. People ask me all the time, what's today's interest rate? And it's kind of like, well, that's like a moving target, right? It just depends on that person's situation. So
What do you think? Is there any, because we get a lot of people that ask, we have the regular 20% down, and you did touch a little bit about the FHA loans, the 3%, 3.5% programs that are available. Any benefits to putting more than 20%? Because we have a lot of clients that say, oh, what if I put 30 or 35?
in some cases with certain types of loans, if you put 25% down, you'll get a tiny bit better rate. Even if you go below 20%, mortgage insurance is relatively inexpensive these days. So,
Like what? Give an example.
well, I don't have the numbers in front of me, so I'm just kind of throwing out a number. But if you have a $500,000 loan, let's say, and you're buying a $550 purchase or whatever, so you put 10% down, right? Your mortgage insurance may only be $100 a month, depending on credit scores, depending on debt ratios, right?
That's
So
really
that's
not bad,
not
yes.
that's not that bad.
Yes.
It's different from the days where, and some people will pay a lot of money, or a good portion for mortgage insurance. Don't get me wrong, but it's not like the days where everybody's mortgage insurance was $500, $600 a month, because that's the way it used to be. Now they've kind of divided it out, and depending on risk and areas and property types and down payment and reserves will dictate, mortgage insurance. So everything's is risk based
Okay.
these days.
From the real estate perspective, a lot of clients like to put more than 20% down when they have it, But as you're saying, it doesn't affect their loan, but it does affect how the seller looks at it when we're in multiple offer situations, because they feel that they are less of a risk. So their loan contingency is a lot stronger when they put them more down. But the bottom line is the sellers end up getting what they're getting regardless of whether it comes from the
Correct.
buyer or from you.
Yeah, I think a lot of it has to do with the way that the listing agent and the seller feels about the loan officer and if they can perform and how the loan looks. That's why there's a lot of cross qualification going on,
Mhm.
where a listing agent will say, hey, I know you got a pre-approval from your loan officer or your bank. I just want you to talk to my person.
Right.
And we do that all the time. And we're not trying to steal the loan. We're
Right.
just trying to make sure that our seller is protected
Right.
and that deal is gonna go through. Because it may be price-wise, the 20% down may be right at asking price or lower. And maybe the 10% down or the 3.5% down is $20,000 or $30,000 over asking.
Right.
So it may be more beneficial for the seller to take that as long as the loan goes through.
Right.
Right, so everybody wants to know if the loan's gonna work or not.
Okay, any advice for existing homeowners, whether they wanna move up, buy a bigger home, size down, size up, maybe take out some equity, pay off some debt and so forth?
Yeah, I mean, it's always, most people have these 3% rates. So nobody wants to refinance and take a 6% or 7% rate to get cash out to pay off debt. In the long run, I have clients that will do that because what I tell them is that you're gonna save $3,000 a month in credit card debt, and it's only gonna maybe add $500 or $1,000 a month to your mortgage. And you can always refinance. You're not locked in this loan forever. It's a 30-year term, but it doesn't mean you have to keep the loan for 30 years. We like people to keep it for 6-7 months, so that way we don't, it's better for us basically because the investors look at it as churning loans.
Mhm.
So they like to see loans perform for 6 or 7 months before they get refinanced.
Do they have a
And some-
prepayment penalty if they pay it off before 6 months?
Not your traditional loans, owner-occupied loans, no. You only have prepayment penalties when you get into investment properties in some cases and certain types of loans. But the key is that you're not locked into that loan forever. It's a tool to accomplish what you wanted to purchase. So you may only have that loan for a year, maybe 2 years, and then we'll try to, ride the market down a little bit.
Okay. With that said, can you talk about investors? What kind of loans are available for them? What kind of rates are we seeing with investment properties?
Well, risk dictates the rate, bottom line. If we can document your income and you're putting 25% down, 30% down, you're probably gonna get the best rate out there, which is usually about 0.5 point above what everybody else gets.
You mean with residential?
With residential, yeah. So let's say if residential's at 6.75, you're probably gonna see 7.25.
For an
Right, for an
investment
investment property with 25% down, really good credit, and we can document your income, okay? There are other programs out there where we can use different income documentation and the rates go up because there's a little bit more risk, but again, we're trying to accomplish your goal, right? What is it that you wanna do? I wanna buy this property because I feel it's a good investment, and the loan's just a tool to accomplish that. So there's other loans out there where we show less documentation and you could be at 9%,
Okay.
8.5.
So you're referring mainly to somebody that wants to buy a second property.
Mhm.
at a residential. What about apartment buildings? 4 units, 5 units, 10 units?
Well, the 1 to 4 unit falls under
Right.
Fannie Freddie or conventional, basically. Above, 4 units becomes commercial. Commercial is a whole different animal. They look at performance of the property over a borrower's credit. A borrower's credit's important and their reserves, but it's the performance of the property. So that dictates different rates, and most of them are adjustable rates.
Do you do commercial loans?
I do commercial loans. We don't do a lot of them anymore, just because they're not as popular. Most of the banks end up doing a lot of those, but we still do them. We'll do them. Yeah, we'll try to help with anything. It's like land loans. Land loans are tough because investors don't want to invest in land, right? So every market has hotspots or desirable properties and not so desirable properties, right? So it just depends on the market. It could change next month where commercial is the thing or land loans are the thing, So it just depends on what the market demands. But loans, loans are tools, in my opinion.
So I think in closing, the bottom line is that if you're thinking of buying, they need to talk to you first.
For sure.
Because the rate might vary from person to person, their qualifications, the different programs you might have to offer. So could you please let us know how they can contact you?
Yes, you can contact me, call me anytime on my cell, 805-432-4898, or you can email me, Jeff Baum, JEFFBAUM, at csmcmortgage.com.
Wonderful. Thank you,
Thank you.
Jeff.
Thank you.